You recently completed a research paper on the current small cap market cycle. What did you find?
We took a look at the last 5 years and we found three things of note: low and declining cost of capital, low volatility, and perhaps surprisingly also high returns. So let's take those one at a time. So cost of capital, a good metric or proxy for that is the yield spread on high yield bonds, say, versus treasuries. So that lets you know how easy it is for a company, perhaps a company with more debt, to access capital. Well, you go back to the spring of 2009, and that yield spread was 18 percentage points. You roll forward to the end of last year, and that was only 5%. That enormous decline had a very favorable effect on companies with a lot of debt. The world behaved almost upside down. Is that the way capitalism normally works is there's a penalty for having a lot of leverage. But during this period, that was really a benefit to as much leverage as possible. The second thing that we found, and I think this might strike most investors as surprising, was how low volatility was compared to history. If we took a review of the headline and we remind ourselves about the perpetual European crises, government shutdown or fiscal cliff or various QEs, I think an investor would say, well, it's probably been a pretty volatile period. And it's actually been below average in terms of volatility when you compare over the past number of decades. And then perhaps even more surprisingly, what's been coincident with that has been higher than average returns. Over the 5-year period, the small cap returns have compounded over 15% a year. Now, if we go back all the way to the history 35 years ago when the small cap index started, and we look at rolling 5-year periods, that's in the top quartile of returns that we've ever had. And again, probably a bit surprising to investors that you've had that good returns, way above average returns, in a period with low volatility.
I guess the obvious question here is, are any of those factors showing signs of reversing?
Actually, all three are in different stages. So the cost of capital or yield spread or what it takes for a more indebted company to access more capital, that very clearly is beginning to reverse. We saw in 2014 the yield spread on high yield bonds go up about 100 basis points. So that's going to create more differentiation across companies with different balance sheets. The interesting thing about volatility is it's not clear why has it been so compressed. One theory, which seems to hold some credence, is in the U.S., the amount of liquidity that was injected by the Federal Reserve acted as a shock absorber. And in terms of returns, our outlook is it is unlikely to see the sort of mid-teens return for small caps going forward.
What kind of effect did these factors have on Royce Fund's performance?
From an absolute return perspective, many of our strategies delivered higher than their long-term historic returns, but they also delivered below the benchmark, so weaker relative returns. And there are very clear reasons for that. So if you're a risk-aware manager that tends to exclude companies with a high amount of debt, those companies have been the greatest beneficiaries of this decline in the cost of capital. So that has benefited, if you will, the benchmark, but not our portfolios. When the cost of capital rises, the differentiation on quality of balance sheets tends to play more to our favor. What we're doing as active managers is trying to isolate those situations where there's a difference between a company's true worth, in our view, and the stock price. When the stock price is more volatile, we're going to have more opportunity to do that. So lower volatility, we've looked historically, has been periods where we have not done as well. Higher volatility, we've done better. And the third, in terms of absolute returns, has been the most striking, is that when there have been returns 15% annualized or above, those have been among our weakest in terms of relative performance.
Obviously, this has been a pretty challenging period from a performance standpoint for many of the Royce funds. What does history show happens after these periods of underperformance?
So we looked at Pennsylvania Mutual Fund, and we looked at the entire history of the Russell 2000 index, looking at rolling 5-year periods. And we said, how often has the Pennsylvania Mutual Fund underperformed by 300 basis points or more, and then what happened after that? And we found about 30 periods where it underperformed by that amount. In the subsequent 5-year period, 92% of the time, Pennsylvania Mutual Fund outperformed, and even though it underperformed by 300 basis points or more in that period, the outperformance was over 600 basis points. So we're hopeful that we'll have that kind of reversal again.